Thank you so much to everyone for joining today. I'm Caroline Nagy, and I work on housing policy and housing and insurance policy at Americans for Financial Reform Education Fund. We're thrilled to join with the Vanderbilt Policy Accelerator to host this virtual talk with Brian Shearer, author of a hot off the presses white paper, How to Lower the Insurance Tax by $150 billion, which was released today, followed, and after speaking to Brian, we'll be following that with a panel with Sharon Lewis, who's the executive director of the Connecticut Coalition for Economic and Environmental Justice, and Harvey Rosenfeld, founder of California-based consumer watchdog, to give us some more grounding on what rate insurance regulation looks like at the state level. Brian's paper comes at a crucial time as families nationwide are finding it much harder to afford home insurance if they can even find insurance coverage at all on the private market at all. When we opened registration for today's event, we asked folks for questions they'd like answered. And I'd really like to thank everyone who took the time to share their thoughts with us. It was very helpful in preparing. And it's very clear that people across the country are struggling with premium increases and that y'all are looking for answers. And, we know that there's a lot happening in the insurance space right now. Obviously, climate change is driving more frequent and severe natural disasters. However, we know that that's really just one piece of this puzzle. And that's really what Brian is going to dig into today for us. So, with that said, I'd like to introduce Brian Shearer. Brian is the Director of Competition and Regulatory Policy at Vanderbilt Policy Accelerator, where he writes about network, platform, and utility regulation and pricing. This includes recent reports on credit card rate caps, electricity utility bills, price gouging captive consumers, and more recently, inflated property insurance pricing. Brian was previously the Assistant Director for Policy Planning and Strategy at the Consumer Financial Protection Bureau and was a founding legal director of Justice Catalyst Law. So welcome, Ryan, and let's get started.
Thanks for
So,
having me.
Ryan, you recently released this academic paper and policy brief on property and casualty insurance. First, for the audience, when we are talking about property and casualty insurance, what kinds of insurance is that? And what is the main thesis of your paper?
Yeah, so it's basically all insurance other than health insurance and life insurance. So that's auto insurance, homeowners insurance, workers' comp, business liability, pet insurance. It's really sort of every other type of insurance product, and it's both for consumers and also for businesses large and small. Um, and the basic thesis is that we just 2 years reached a huge milestone in this country. We now spend over $1 trillion a year on property and casualty insurance premiums. That's more than we spend on the US military. It's about as much as people spend on food total in the entire country. So it's a huge expense and it adds quite a bit to the affordability crisis. And what my paper shows is that the prices are high, but they also don't need to be that high. They're inflated by things like profits and over high investor returns and advertising budgets and frivolous expenses. And you can tell that by looking at the ratio between how much they're spending in claims and how much they're collecting. And recently, it's that ratio has gotten a lot lower than it used to be. And so my paper proposes to use existing sort of traditional policy tactics to rein those prices in and save Americans about $150 billion a year.
Wow, that's a very large number, both in terms of the scope and the potential savings. Something that I found very interesting about your paper is that you really take some time to delve into the history of insurance. And I'll say, personally, I was really a bit surprised. just how interesting and populist our history of insurance regulation is in this country. Could you tell us a bit more about this?
Yeah, I agree. I think it is important. I think a lot of the times when you hear about the history of insurance or insurance regulation, it's this very dry, kind of bland, bloodless story. But it's a lot more interesting than that. In many ways, insurance was kind of at the center of the country's political economic history. Insurance was the first, basically the first large corporate market. Back in the 1850s, most business was done in small businesses, local businesses, maybe regional, but insurance was already at that point huge national corporations, even international corporations. And for that reason, it was also one of, if not the first target of a real populist pushback. In the 1910s, um, various states created price regulations, basically limits on prices in recognition that the prices were really high and there was this kind of popular voter uprising to crack down. And those still exist today. And the historical story is it's full of compelling moments. For example, in the 1910s in New York, a guy by the name of Charles Evans Hughes, who became a Supreme Court justice and ran for president and was a huge political figure, but at the time he was kind of a nobody. He started his career by holding hearings in New York that were so scathing about the bribery and price gouging and crimes that were happening. It was so scathing that every single one of the major CEOs of every single insurance of the major insurance companies in the country resigned in shame, and then many of them had to like flee the country. Um, so that was the kind of tenor of how the existing insurance regulatory scheme came to be. Another good story in Texas, when price regulations were first introduced, the insurance industry came together to fight it and threatened to leave the state if the state didn't let them charge high prices. And instead of acquiescing to these kinds of threats, which by the way, this pattern happens today all the time too. And usually today, what happens is uh, government officials will get scared off. But that didn't happen in Texas. In Texas, instead, what happened was the governor called a special session of the legislature to double down, make the price regulations even stronger, and called on the legislature to banish every one of the insurers that had threatened to leave. And it's not just in the history books either. I'm actually so excited that Harvey Rosenfield's here because he led a campaign that was sort of in the same vein in the 80s, late 80s, in California to pass a proposition to lower insurance prices. And this was in the middle of deregulation and the Reagan administration. And it was one of the most hotly contested propositions in California history, but it passed. And I think one of the most remarkable things about it was that it had just a flat 20% cut to all of the prices in the proposition. Every insurer had to just cut their prices wherever they were. They had to cut them by 20%. And it worked. And the insurance industry claimed it was going to be a crisis and the sky would fall and they wouldn't be able to do business, but that didn't happen. They continued to do business. Californians saved a lot of money. They're still saving a lot of money because of it.
Well, thank you, Brian. Yeah, that Texas example is, I think, really illustrative of the fighting spirit that we had in earlier generations of insurance regulation. Um, Switching gears a little bit, I mean, I think your analysis here and what you're talking about really runs counter to the prevailing media narrative on property insurance. What we often hear in the news is that property insurers are in a crisis, and that they have to increase prices or just stop insuring. And so the role of states is to protect and promote insurer profits. For example, it's really fairly common to hear stories about how insurers are victims of climate change. But we're also hearing in New York and Florida, other narratives about how excessive litigation is what is increasing costs. Are these false narratives or what's going on?
Well, this is kind of the insurer public relations playbook going all the way back to that story in Texas over 100 years ago. They threaten to leave a state unless the insurance commissioner will let them charge high prices because they can't just charge whatever they want. Usually they have to get permission from a government official. And so they threaten to leave um, unless the prices go up. And to sort of justify that threat, to make it look like it's not just pure political leverage, they will hide behind a narrative around rising costs. And a very common one you hear is the litigation costs are out of control and we need to raise prices, which is often overblown. And to be clear on the climate change front, that's real. I mean, the costs are really going up, and it is a crisis. But what we're seeing is that instead of insurers kind of leaning into it or absorbing some of the increase in claims, they're increasing prices to defend their profit margins and excessive spending. And in fact, they're even increasing their margins to be even more. They're kind of taking advantage of the crisis by increasing prices more than they need to. And so what we really need to be doing is paying attention to the part of their budgets that's not going to claims, the part that's being spent on things like um, dividends and advertising and private jets. And to be clear, many of them do own multiple private jets, which they pay for with premiums. Right now, the way you can tell that it's overpriced is by looking at something called a loss ratio, which is the ratio between claims and premiums. It used to be the case that for every dollar in premiums, they would pay out about 80 cents in claims. It's now closer to 60 cents today. And that's just a trend that's happened over the last couple decades. And so it's really they've really gotten less efficient, and they're sort of getting more money that they're spending on other things. And it's really getting worse right now. Things are really spiking. In 2024, their profits doubled. In 2025, it looks like the profits are continuing to rise. I mean, some of the major insurance companies are paying record dividends and stock buybacks right now in the middle of the insurance crisis. And so, something other than rising costs, rising claims is also happening here.
Well, thanks, Brian. Yeah, I mean, when you talk about advertising expenses, like I just wonder, of the nearly 200 folks on this today's webinar, how many of us could name like two jingles or animal mascots? It is kind of really wild to think about just how saturated we are with insurer advertising. So. One more question before we bring out the bigger panel, and this is really about solutions. You've made some suggested policy solutions, and our audience is probably most interested in state level solutions, especially given the current federal environment. So, could you explain what are some state solutions, and as well as any federal solutions suggestions?
Sure. So I think there's really two things that we can do. The first is demand that our insurance commissioners hold the line on the price increases, right? So currently, insurers either file their rate increases for approval, or at least the insurance commissioner has the ability to reject an increase. And we need those officials to be holding the line and not letting the prices get any worse. And to do that, they can really, I think, um, focus on the non-claims cost. I think often the focus in insurance circles is to focus on the kind of actuarial tables and look at the claims and how they're going to be increasing over time, which is very, very important. But also, they should be looking at how much the executives are being paid, and how big is your advertising budget, how much money you're spending on corporate parties, and is it reasonable to be spending as much as you are on agent commissions? And look at the private jets, and maybe instead of increasing prices, they can sell the jets. And so I think insurance commissioners could be doing more to hold back the price increases. And then the other thing that I suggest is legislation. And the kind of three main things that I think we could do. The first is set a loss ratio floor, which is something we have in health insurance. So it's not a kind of radical or novel idea. But we could set a floor of 80%, and that would lower prices by $150 billion a year, which is a whole bunch of money. Um, the other things are smaller, but and potentially less dramatic, but still very important. I think one thing is just transparency. It'd be great if we had more transparency into those costs that aren't going to claims. How much money are you spending on advertising, on private jets, on lobbying, on campaign expenses, executive compensation, that kind of thing. The insurance industry already has to disclose a lot of the details of their business, like how much they're paying in claims, how much they're collecting in premiums, and it's all public. But the breakdown of those costs, I think, would be very helpful because if an insurance commissioner is looking at a price increase and then at the same time looking at a ledger showing that they bought 4 private jets in 2024, I think it makes it a lot easier to reject the price increases. And then lastly is I think we could borrow from something that we're seeing across the country on energy utilities. So states like California and Colorado and Maine and Connecticut have passed bans on electric utilities passing on the cost of political donations, private jets, campaign contributions, and similar costs on to customers. And we could do that in insurance too. I mean, they're regulated very similarly, and so it would be something that we could do in insurance too.
Okay, well, there you've given us some really promising, yeah, directions. And yeah, thanks, Ryan, for writing this paper and releasing it with us today. I'd like to bring two more speakers into the conversation as because this is really a national question and this is a state question because so much of insurance is regulated at the state level. So first, I'd like to introduce Sharon Lewis. Sharon is the executive director of the Connecticut Coalition for Economic and Environmental Justice. She's also the founder of Boots on the Ground, an environmental justice advocate training school, and the Community Benefits Alliance, which helps communities understand and negotiate equitable development agreements. Welcome, Sharon. Can you tell us about what shaped your understanding and interest of the issue of insurance industry profiteering that led you to be with us today?
The word profiteering is very interesting. And thank you so much, Brian, because I never thought about it that way, but it is exactly that way. My understanding comes from the ground level. That means working with people who are paying more and getting less. I started to see a pattern, not only as a person on the outside, but as a person on the inside. I used to be an insurance and reinsurance underwriter. I was in underwriting, marketing, claims, auditing. I did treaty reinsurance, facultative reinsurance, broker market reinsurance, direct market reinsurance, surplus lines, yada, yada, yada. I did it all. And I started seeing patterns with certain demographics with regard to rising premiums and shrinking coverage and more barriers when people tried to file claims. All this happening at the same time that insurance companies were reporting record profits at a time of record catastrophes and consumer losses. And I was a little bit confused by that. So that told me personally that this isn't just about risk, it's about how the system is structured. And it raised a bigger question for me. If insurance is supposed to protect people, then why does it feel like the risk is being pushed back onto the people? So what brought me here is that contradiction. We're being told that rising costs are unavoidable because of climate risk, but at the same time, companies are making significant profits, spending billions on advertising, and finding ways to limit their exposure. So I started asking, is this really about risk, or is it about who has the power to decide who carries the risk?
Thank you. Thanks so much, Sharon. I'm very excited to hear some more from you. We're also joined by Harvey Rosenfeld. Welcome, Harvey. Rosenfeld is the founder of Consumer Watchdog. He authored Insurance Reform Proposition 103 and led the grassroots campaign for its passage by California voters in 1988. Since then, he has worked to enforce Proposition 103 while representing Consumer Watchdog on litigation on a wide variety of consumer protection issues, including insurance, healthcare, privacy, telecommunications, and energy. So, welcome. And can you tell us a bit about what shaped your understanding and interest in this issue?
So as Brian mentioned, back in the 80s, there was an insurance crisis just like the one we're all dealing with today. California had no control over what the insurance companies were doing. There was no transparency, and the industry was exempt from the antitrust laws, the consumer protection laws, the civil rights laws. And so when we took our case to the legislature, and the legislature, beholden to the insurance lobby, as is often the case, turned us away. So luckily in California, we have access to the ballot, and we created a campaign called Voter Revolt. And I'm going to tell you what was in the initiative that we proposed. It required it across the board, as Brian mentioned, 20% rollback of all insurance rates. It required the insurance companies to open their books, subjected to public scrutiny, and get the insurance commissioners' approval before they could charge a rate. And that process today, and under Proposition 103, allows consumer groups to independently intervene, review, and challenge rate increases in case the insurance commissioner perhaps isn't that interested. Prop 103 also bars a lot of discriminatory practices. It made the insurance commissioner an elected post. As I said, it actually regulates some of the expenses that Brian mentioned. The institutional advertising bars the pass-through of political donations and lobbying expenses. The critical thing people have to understand is this can work. I want to first of all thank Americans for Financial Reform for hosting this, and Brian, great job. Your report's going to really be a kick in the butt for public officials who really tend, as you pointed out, there's a strange paralysis around insurance. It's partly because it's complicated, partly because it's boring, but it's a huge pocketbook issue that affects everybody, which is why when on election day in 1988, the voters, to my surprise, passed Prop 103, despite a $63 million advertising campaign against it from the insurance industry, and ours was completely grassroots funded. So I look forward to being part of this, and congratulate again all of you for putting this together.
Great. Yeah, such an exciting panel. We've got both coasts, we've got some theory. And I'd like to start. As I said in the beginning, when folks registered, we asked if they had any questions. And I just want to reference a comment shared with us from one attendee. From 2011 to 2025, my homeowner's insurance went up 228% with no claims and the same coverage. And this was something that, actually we heard a lot of very similar stories from folks. They're trying to figure out like why their rates went up so much, and whether this is fair and just like what's happening and who's keeping an eye on. So, I'd just like to ask you, what does state insurance commissioner rate oversight look like today? And how does the insurance industry operate in rate hike disputes? And I'll start with Brian and then pass it on to Harvey and then Sharon.
Sure. So first, I don't think it is fair, right? I mean, I think the evidence shows that the price increases that we've seen over the last decade or so, maybe some of it is justified, but it's inflated, and the prices today are much higher than they need to be. And so I see stories like this, and I looked at some of the questions that came in, and it was kind of an overwhelming number of very similar stories of people who were angry and confused about why their prices are so high. And I think the answer is um, we're all being price gouged, and it's really a shame. The way the system works is, unlike most, markets in the economy, insurers in many states either have to get approval to increase their prices, or at least a state official can reject the price increase after the fact, which you don't see in most markets. And so that should be doing something to hold the prices back and keep them reasonable. That's the intent of them. But the process breaks down, and we need to the regulators who are focused on this to hold the line. And part of the problem is that what ends up happening is, especially in small states, the insurers will threaten to leave in order to kind of get the approvals. And so in some ways, the regulators are in a tough spot, um, but we need them to call the bluff and to be tougher and stand up to those kinds of threats.
Thanks. Harvey, do you want to weigh in too?
Yes, so as that reform that I mentioned, Proposition 103, it worked for a long time. It saved motorists, for example, 165 billion on their rates over a period up to 2019 from 1988. Um, uh, we, Consumer Watchdog, take advantage of that opportunity that the voters gave consumers to challenge what appeared to be excessive rates. And so we alone, Consumer Watchdog alone, has saved homeowners, motorists, and small businesses in the property casualty marketplace $6 billion. Just us intervening to that tells you how much waste and inefficiency there is in these rate applications, and we get to probe them. Now, going to a point Brian just made, and it's something we're dealing with right now, even though there's an elected commissioner in California, that doesn't guarantee that you're going to get somebody who's going to enforce the law correctly. And we're dealing with that right now. The current insurance commissioner basically was told by the insurance industry, we're going to leave unless you roll back some of the protections of Prop 103. And he capitulated, he surrendered. And we have a lot of legal rights to deal with those kinds of situations. But in the meantime, the commissioner in California has given the insurance industry all of the reforms it said it wanted, and rates are still going through the roof. And it hasn't done anything to really help consumers, what the commissioner has done.
Thank you, Harvey. And yeah, Sharon, for you, I mean, same question. What are you seeing in Connecticut? And yeah, how are insurers behaving in these disputes?
Well, I agree with what both of the gentlemen said. I just want to add a few things. There's a tension in the system that a lot of people are not aware of, and that is people don't quite understand uh, how their policies are priced, nor do they understand the actual coverages. And I've often lamented that fact, especially in Connecticut, the so-called insurance capital of the world. It's just outrageous that so few people in this state understand how to read their own insurance policies or even the coverages. So we as consumers are not equipped to challenge the rate hikes because we lack the understanding of what a rate hike is, how it is approved, what the insurance commissioner does. What I do know personally is that the system, I would say, is rigged because the insurance companies control the whole process. And if you have a commissioner who does not understand insurance, that commissioner is going to do what he or she is told to do. And that's very, very depressing. It's extremely technical. And that's one of the reasons why consumers lose because they don't understand.
Thanks. And we're getting some questions from the audience about ways to get involved, and how to plug in on things because yeah, you're right. It's not an equal playing field, and folks do need some education. So, we can talk about that a little bit more towards the end, but Right now, another big comment from folks in preparing for today's signing up for today's webinar was remarking just how prominent insurance company advertisements are on TV and social media. And one thing in Brian's piece is that, insurance companies are spending consumer premiums inappropriately, right? Yeah, and spending way more than they should be on things other than paying out claims. And this can be like advertising, commissions, shareholder dividends, and stock buybacks. Is this a practice that you've seen? And if so, can you tell us about it? And maybe here, who would like to go first? I'll go with Harvey, if that's all right.
Well, just as I mentioned, one of the rules under Proposition 103 is that the insurance company's expenses are very carefully examined, and institutional advertising is not permitted. It's the rules limit how much money an insurance company can pass through to its policyholders for those kinds of expenses, same like lobbying costs and so on. So it's a real problem that Brian has identified.
Thank you. Brian or Sharon, did you want to add anything there?
Sure, I think especially on the advertising, one of the things that's going on, one of the reasons why the prices are so high is it seems like we're in an advertising arms race. So, with insurance, you this is in many cases a mandatory market that you have to participate in. It's also, very rarely the case that the advertisements you see talk about the differences in coverage. It's always just kind of brand awareness advertising. And and in fact, insurance is of all of the markets in the economy among the very top most expensive cost to acquire a new customer. And like I think everyone can sort of see this. Like when you watch the Super Bowl, there's beer ads and there's property insurance ads, and maybe a couple of other things here and there. But the property insurance ads are really a big part of it, right? You've got Flow, Nationwide is on your side, the Geico Gecko, the Caveman, like all of that stuff was property insurance. And I one of the issues is because they're not really competing on price or they're not competing on um, terms because they're hidden in fine print. They're spending all of their money competing on advertising, and that's actually jacking up the price that everyone pays. And so, in some ways, what a loss ratio floor like I proposed would do is sort of end the arms race and just tell everyone you all have to keep your ad budgets reasonable. And then no one of them is, burdened by the fact that their competitor is spending more money than them because they all have to pull back.
Well, thank you, Brian. Yeah, I mean, and it's interesting, Harvey, your example of California, where you ban those kind of expenses. Does that mean that people in other states are subsidizing advertisements for California? I mean, I think that is one of the paradoxes we see, right? Where the lower amount of the states that have the more regulations. Are subsidized sometimes by overcharging in states with less, which is exactly why, we need some standards to end this arms race. Sharon, did you want to weigh in here, or should we move on?
No, no, I would like to weigh in briefly.
Great.
Because from what we're seeing is a real disconnect. On one hand, the consumers are being told that premiums have to go up because of the rising risk with regard to the climate impacts, rebuilding costs, and so on. But on the other hand, we're seeing significant spending on advertising, on commissions, on executive compensation, executive perks, and returns to shareholders. In addition to that, because I'm in the environmental justice arena, we're very concerned about investments in the fossil fuel industry. And I say investments because we often speak of insuring the fossil fuel industry, but they also invest in the fossil fuel industry, something that people are not aware of. So, it matters because these costs don't exist in a vacuum. They're built right into the rates that people are paying. And on the community level, what I see is people struggling to keep up with rising insurance bills, while at the same time, they're being bombarded with ads from the very companies raising those rates. And it creates a real sense that the system is not prioritizing protection, it's prioritizing growth, market share, and profit. And I think that's the core issue. Insurance is supposed to be about managing risk and providing stability, but when too much of that premium dollar is going toward competing for customers instead of serving customers, we have to ask whether or not those incentives are aligned the right way.
Well, thank you, Sharon. And this, yeah, this goes perfectly into our next question because, you mentioned that insurers are continuing to invest premiums into fossil fuels. And yeah, I mean, and we know that that climate change is real and that it is causing more damage to buildings, which does cost more to repair. Um, right now, what we're seeing is that, insurance companies are just passing those costs on to consumers, even continuing to invest in fossil fuels that are actually continuing to exacerbate the issue. Um, what should we be asking insurers for right now on climate mitigation and resilience? And what can an insurance commissioner do to address it? Anyone want to go first?
I'll go first this
All
time.
right.
I think that what we should be asking right now is something that the insurance companies already do. For example, if you want to insure your home, most likely you get a binder until the loss control person comes out to inspect your house. Then the insurance company will tell you if you want us to insure your house, then you have to fix your roof or you have to repair this, repair that. They're doing this in advance of a loss. So why can't the insurance companies require people? I'm sorry, why can't they help us prepare for disasters by helping us to mitigate the losses that they know we're going to get? Because the situation is this, and we should be very clear about this. The insurance companies are helping to shape the disasters that we're all experiencing, and they should also help to shape the mitigation. They should also help to make us resilient. And it should not always be an after the fact situation. Just as they do their business currently, it should be a before the fact situation. Because if you have a house that is not worthy of insurance, before you get that insurance, they're going to make sure you fix what they need fixed.
Thank you. Yeah, and this is a perpetual issue, where we really want to see investments in home hardening and mitigation. Yet, when folks do that, sometimes even though they're making their home safer, they'll see their premiums go up because now insurance companies saying, "Well, your house is worth more now that you got a good roof." And that's, usually we actually have to get legislative language requiring those discounts to be passed on. Harvey, do you want to would you like to add to this?
Couple of thoughts. Want to congratulate Sharon on the work she's doing. One of the interesting things about the battle in 1988 over insurance reform with the insurance industry was that the voters passed a law that not only reduced the rates, but barred the kind of discrimination that is institutionalized. They get to discriminate in most states in the United States on the basis of where you live, as opposed to how you drive. The voters changed that. And the proposition kind of created a voter coalition of middle income and low income consumers who were being harmed by the industry's lawful discriminatory practices. So that's a big deal. Stopping these practices is something that every state commissioner should undertake. I want to also say the same thing that Sharon said about the insurance industry basically subsidizing this climate catastrophe, and the commissioners should investigate, force the companies to disclose which fossil fuels firms that these insurance companies take our premium dollars and invest in. Second, investigate underwriting, because what's happening, it's a little bit like what the tobacco industry did. The insurance industry is externalized by underwriting fossil fuel facilities. The insurance industry is externalizing the downstream cost of that, which in the case of climate change is the health and catastrophe of that's caused by and the financial catastrophe of wildfires, for example.
Mhm. Thank you. Brian, anything more on yeah, what we should be asking for insurers and state commissioners regarding the challenges that we're facing due to climate change?
Yeah, I mean, I think the mitigation requirements and also the investment in fossil fuel proposals that folks already talked about are great. And I also think that there is an interesting role that insurance and insurance regulation plays in the broader economy. I think there's some people who maybe a little bit flippantly, but it's not entirely a joke, would say that insurers rule the world because they are in many places of the economy and in life, they're creating incentives and creating conditions on what you need to be doing in order to get insurance. And with that in mind, maybe we should start thinking about lowering the premiums for clean energy projects and raising the premiums for other projects that create externalities like fossil fuel projects. Um, and so I do think that insurance and the climate crisis are kind of intimately intertwined, and there are a lot of solutions from insurance regulation that we can bring to bear.
Can I just jump back?
Thanks.
Brian, thank you so much
Absolutely.
for that because insurance companies do rule the world. I've been saying this for many, many years, and people have always pushed back. There's absolutely nothing, as far as I'm concerned, that you can do without insurance. And lately, I'm disappointed in the fact that now the new proxy for discrimination is insurance companies, and two major ones in Hartford are going all over the United States, not insuring developers who build affordable housing. Not
Well,
that, but they're looking at the people who live in the housing. What does that have to do with a building burning down? What's that got to do with the casualty of somebody falling or whatever? Nothing. But it's just a new proxy that continues to morph.
yeah, and absolutely, Sharon. Yeah, and this again transitions us perfectly into my next question, which we're seeing like you mentioned unfair factors. We're seeing increased data on home insurer use of credit scores and neighborhood racial composition in determining premiums. As a recent report from the Federal Reserve put it, insurers are pricing rates, quote, for who is living in the house rather than the risk of the house. Um, how do these practices and similar practices harm Black and Brown communities? And actually, Sharon, since if you'd like to go first on this one.
To say that this is not new. I find it to be amazing that people are all of a sudden talking about this as if it's new. The insurance has a very ugly history when it comes to
Mhm.
discrimination against people of color from the very beginning. There were times when people of color couldn't even get life insurance. And when they did, it was limited to $5,000. And when it comes to homeowners or property insurance or insurance for your cars, they used every type of proxy available. There were even proxies for you weigh too much, or you too old, you wear glasses, your education is not enough. It's simply outrageous what the insurance companies have done and have gotten away with. Credit scores has been number one. And even to this day, people don't know that the insurance companies are using your credit score to price your risk. And even if your credit score is good, they're still going to price it the way that they want to price it. So I just find it to be appalling that these situations are continuing, and it's harming Black and Brown communities because it's preventing Black and Brown communities from creating wealth. You can't create wealth when you can't afford to buy anything. You can't create wealth when you can't provide, I'm sorry, you can't have insurance. You can't start a business without insurance. You can't finance your equipment without insurance. You can't have a mortgage without insurance. That's why I tell people you can't do anything without insurance. They are the gatekeepers of our society. And we need to understand that. And I think that once enough people understand that, that's the way we create change.
Thank you. Amazing, Sharon. Who wants to follow up with that?
I can. So I come from a bank and lending regulation background. I worked at the Consumer Financial Protection Bureau, and we enforce anti-discrimination law in lending, and lending discrimination is still a huge problem. But I have been pretty shocked, and Sharon's right, this is not a new problem. Pretty shocked to uh, to learn just how bad the discrimination problem in insurance really is. I mean, I thought we had work to do in lending. It's nothing compared to what's going on in insurance. Insurance is a place where, in many states, they still overtly, explicitly discriminate based on the kind of basic characteristics that in many other places we long prohibited discrimination. Based on race, sex, marital status, things like that. I mean, it's still the case in most states that gender is the main factor in auto insurance underwriting and the prices that you get. And not just a factor, like the big one, the one that is driving what your price really is. And it's egregious and it's unjust and it's especially um uh frustrating because anti-discrimination laws in insurance were passed a lot earlier than the Civil Rights Act. They were passed in the 1910s, and yet those laws were never interpreted to protect people based on race or gender or any of the kind of the later civil rights protected groups, and it's a huge problem. And I think for especially Democratic administrations, insurance commissioners, it's to me it's the low-hanging fruit that they should really be cracking down on and and be going after. And um and it strikes me as something that should have happened decades ago.
Thank you. Harvey, do you want to add here?
Yeah, I mean, a couple of things. Just about every state's insurance law bars unfair discrimination. But as Brian and Sharon are pointing out, the commissioners, Democrats and Republicans alike, don't seem to want to enforce that strongly, partly because I think the insurance industry argues that, well, we can prove that our discrimination is justified. We have data that we can show. And the work that Consumer Watchdog does, a lot of it is blowing up that data, showing it's not credible. But here's another angle on this. We could devote a whole webinar just to this coming looming threat of artificial intelligence and models, because credit scoring, which is not allowed in some parts of the California marketplace, it is just the beginning. That's nothing compared to what the insurance companies are doing now with all of our personal data that they can buy from all the places that we do business. And then they set a price based on our personal characteristics that have nothing to do with our risk as a policyholder. Something for another time, but it's really scary.
Yeah, I know I could talk to y'all about insurance for hours. But yeah, unfortunately, we've only in our last 10 minutes. I'm going to take a question from the audience. And this basically, this is a question actually several people have asked in different ways, but basically, what is it that we can do as members of the public to get involved in this issue? And I'm going to put one plug in very quickly for the Equitable and Just Insurance Initiative, which AFR, Public Citizen, and I think all of the groups here are involved in. And to check out our website at insurancejustice.org. But what are some other recommendations that you have for how someone can get more involved in this issue? Harvey, would you like to go first? I think you might have some. I know you have some ideas.
Well, I mean, like I said, the campaign in 1988 was truly a grassroots effort. When you give people a chance to weigh in on these issues, they always do the right thing. And people all over the country are angry right now. The industry, as you pointed out, scapegoating the legal system, juries, climate change are always trying to find an excuse why they're not responsible for higher prices. But that shouldn't be working anymore. So I think getting this sounds trite and perhaps discouraging, but the only thing really we can do is change the laws to make them more protective of consumers and get these state insurance commissioners to get on the job. Remember, many of them, most of them, are actually appointed by the governor, and that position is usually like a patronage position. It's something that's a reward for the insurance industry in exchange for the governor's campaign contributions. So it's really about empowering the public in an organized way, which is what we were able to do. So surprisingly, in California, tens of thousands of people collected signatures for the ballot initiative that we did, and the average donation from them was $8, and yet it passed. The good news is the industry is very vulnerable, and they're very afraid of grassroots democracy, which is why they're always trying to shut it down.
Well, thanks, Harvey. I'm glad that we're making some people afraid today. Sharon or Brian, would you like to weigh in?
For me, as always, education is the key. One
Mhm.
of the things that we do really well in Connecticut is that we educate people. How can you oppose an incinerator when you don't know how an incinerator works? When you don't know how the trash gets there, when you've never been to one? So we take people on site visits. And I think that this is something we need to do with the insurance companies. For example, it is the only industry that I know of that does not have to tell you how they came up with your premium. Only that I know of that doesn't have to tell you that. And, Brian and I could have the same house on the same street, side by side. My house could have a fire hydrant right in front of it. But why am I paying more than Brian? In fact, my house looks better than Brian's house. But this is the things, it's just, they're accountable to no one. And we have got to change that. Because if we don't change that, what's the point of opposing something we can't see, we don't know about?
First, Sharon, I'm sure your house looks a lot better than mine. Because it's in shambles at the moment. I've got young kids. But one suggestion I have for folks when I get this question of what can they do kind of at the grassroots level is, and this isn't going to be the perfect fix. It's not going to solve the problem, but I do think it's something and it's a start, which is people should start complaining more to their insurance commissioners. Whenever you get denied, your claim gets denied, or your insurance price goes up, or something happens, anything where it feels like um, you're getting screwed in some way, just file a complaint with the insurance commissioner. They all take complaints. People don't file complaints all that often when things happen. I think a lot of people don't know that they can do it. And that is, a data point that sort of builds the predicate for future action, and also it's just a little kind of raising the stakes to the insurer, and sometimes not always, but sometimes it'll cause them to kind of reach out and try to fix the issue. And so file a complaint.
Great. Yeah, great suggestion. We've got organize a proposition to fundamentally overturn regulation in your state, file a complaint, get educated. Yeah, these are all great solutions. So we're almost at the end of our hour, and I just wanted to give each panelist, any closing thoughts, any more policy reforms that you'd like to put in a plug. And yeah, we can start maybe with Brian.
Sure. I think stepping back, what I want to kind of leave with folks is a lot of people are talking about affordability right now, and I think it behooves policymakers to realize that if you're running campaigns on affordability, you have to deliver, or else once again it will feel like you made promises that you didn't keep, and insurance is one of those places where there's real opportunity to lower prices, and not just kind of quote unquote, bend the cost curve, but actually drop the prices. And so, I think any policymakers or staff of policymakers on the call today should maybe perk up and think, oh, maybe property insurance is a place I should be focused on, and maybe we could lower the prices there.
Thank you. Harry, would you like to go next?
Yes, thank you. Going back to the question of citizen empowerment, I should have mentioned this. After the wildfires, tens of thousands of people suffered here in Los Angeles. Both the Eaton neighborhood and Pacific Palisades survivors have organized themselves into really a very powerful group of people who are forcing the governor and the insurance commissioner and statewide politicians to be responsive. So, unfortunately, out of a terrible disaster can come activism that can end up helping people at a broad level. And I just want to offer up our website is consumerwatchdog.org. That's all one word, Consumer Watchdog. And if people want to send me something, my email address is harvey@consumerwatchdog.org. And thank you again for this opportunity.
Thanks, Harvey. And yeah, we're blowing you up in the chat. We got a bunch of your links already. And yeah, thanks for sharing your email. Sharon, last words?
For me, you can't charge people for climate risk on the one hand and finance and insure fossil fuel industries that cause climate risk on the other hand. To me, that's not risk management, that's profiteering. Thank you, Brian.
Thank you. All right. I've learned so much today. I just really want to thank Brian, Harvey, and Sharon, our panelists, everyone who supported this webinar, and of course, everybody who signed up and joined us today. Yeah, insurance might not be the sexiest topic, but we had almost 200 people really engaging, asking great questions. Sorry, we couldn't get up to all of them in the chat, and this just gives me so much hope. And we've got some, great analysis and some good steps, next steps forward. So just once again, thank you, thank you. And please continue to stay involved, stay informed with this conversation because insurance issues aren't going anywhere. Have a great day, everybody. Thanks.